Let us start with the fiscal policy. So fiscal policy is basically related to what? It is related to the government spendings and revenue collection. So government did what? Government actually does what? Government collects the revenue by way of the taxes, by way of the other duties, and further the government also spends on the policy, different policies. So that is all about the fiscal policy itself. So whatsoever the government receives and whatsoever the government spends, that is related to the fiscal policy, and this particular statement is going to influence the economy itself. Okay, so fiscal policy attempts to stabilize the economy by controlling interest rates and supply of money. So what would be the amount of the money that will be available in the market by the government itself, and what would be the amount of the charges or the taxes that will be levied by the government itself, that also affects the economy. So it is having two main instruments. That is, first of all, it is related to the government spendings, and the other one, it is related to the taxation. It is related to the taxation and further the government spendings over there. So changes in the level of the composition of the taxation and the government spending can have an impact over the variables in the economy. Let us have a look at it. First of all, aggregate demand and the level of economic activity, it is basically affected. These variables are impacted by change in the taxation and by change in the government spendings over there. So first of all, it is related to how the demand will change, and second, it is related to that the resource allocation pattern changes, the income, the distribution of the income has an effect over that. So these are the different variables which are impacted when the taxation and the government spendings are changed. Okay, so fiscal policy refers to the overall effect of the budget outcome on the economic activity. So the overall effect of the budget outcome on the economic activity is the fiscal policy. So government use the fiscal policy so as to influence the level of aggregate demand in the economy. So let me tell you that how it actually works. So if the government is spending in some particular area, that particular area or the field will be getting the boost related to it, and further there will be more money inflow and outflow due to this particular purposes, and definitely the demand is going to raise. Okay, so let me tell you that if the government has added a special category under the priority sector lending, ultimately the credit to that particular section will increase, and ultimately that will lead to the growth of that particular area, and ultimately the demand and supply to that particular sector will raise over there. So that is an effort. So it is an effort so as to achieve the economic objectives. Which are those objectives? Related to the price stability, related to the employment, and related to the economic growth. The related fiscal policy is related to it. So let us consider the FRBM Act, that is the Fiscal Responsibility and Budget Management Act. FRBM Act, that is the Fiscal Responsibility and the Budget Management Act. So the committee headed by the Dr. E.A.S. Sharma was set up in January 2000 so as to recommend the draft legislation on the fiscal responsibility. So a committee was basically set up in January 2000, and this committee was under the headed by Dr. E.A.S. Sharma, and further the bill was introduced in the parliament in December 2000 and further enacted as law in August 2003. So committee was set up in 2000, and further the bill was introduced in parliament in 2000, and further it was basically enacted as law in August 2003. So let us have a look at the four main requirements of the FRBM Act. What is the full form of this? It is a Fiscal Responsibility and the Budget Management Act. And let us have a look at the main requirement for this. First of all, it requires the government to place before Parliament three statements. So three statements are to be produced by the government in front of a Parliament, before the Parliament, and further these are basically related to along with the budget, covering the medium term fiscal policy. So what these three statements are? It is related to the medium term fiscal policy strategy, and the macroeconomic framework. These three policies, these three statements are to be submitted before the parliament along with the budget. Okay, so let me basically cover this, iterate these again. These are medium term fiscal policy. These are related to medium term fiscal policy strategy, and macroeconomic framework. Okay, the content is prescribed in the act, and the formats are basically given in the rules itself. Okay, so it has basically the content in it. The rules are different. The rules are associated with. So each and everything is covered. That what would be the format, what would be the different contents related to it. Each and everything is covered in the FRBM Act itself. Second, it is related to the act lays down that fiscal management principles, making it incumbent on the center to reduce the fiscal deficit. So what is the main issue related to it? Let us take the case that government has a different sector. Let us consider that these sectors are related to the defense, and this is related to the health, education, and all the different sectors over there. And government has a agenda that the government will be spending that much amount on defense and health and education and all the things. Let us consider that the total aggregate amount that is to be spent by the government over the year, it comes out to be 3.8 lakh crores. It comes out to be 3.8 lakh crores. We are just considering, we are just having a random figure over here, nothing to do with it. Okay, so the government spendings come out to be that it will be spending 3.8 lakhs crores. And for the, if we look at the revenue side, that is on the taxation side, that is the main component of the revenue, and on that particular side the government is basically having revenues equal to, let us say it is 3.10 lakh crore. It is 3.10 lakh crore. Now the revenue is lesser than that of the spendings. That is basically related to what? That is called the fiscal deficit. That is called the fiscal deficit. So Act lays down a fiscal management principles that the government is to reduce the fiscal deficit to zero. Okay, and further there is no target mentioned related to this particular purpose, that how much percentage must be kept within, but the rules prescribe that the fiscal deficit target is 3%. It is 3% of the GDP related to it. Is that clear? Okay, so there is a agenda that is mentioned in the act itself, that there must be principles related to that we are to reduce the fiscal deficit to zero. There is no target mentioned in this particular act, but the rules prescribe it to 3% of the GDP. Okay, so it requires the government to set a ceiling on the guarantees. So government has to put a bar that what amount of the guarantee the government is extending. Okay, and the rules prescribe that the guarantees must be limited to 0.5% of the GDP. The act provides also, there is also an exemption given to it. So as under the extraordinary situations or under the exigency situations, if there is a natural security or natural calamity, in that particular case that is an exception case, and this limit is not to be regarded in that particular case. Is that clear? Further, third, Act prohibits the center from borrowing from the Reserve Bank of India, that it means deficit financing. The Reserve Bank of India itself cannot finance the deficit. Fiscal deficit cannot be financed by the Reserve Bank of India, and it prohibits, the Act particularly prohibits the center from borrowing the Reserve Bank of India. Okay, and also the Reserve Bank of India is barred from subscribing to the primary issues of the central government securities. If the central government securities have been issued by the securities have been issued by the central government, in that case Reserve Bank of India is barred so as to subscribe to the primary issue. Primary issue cannot be subscribed by the Reserve Bank of India, though the Reserve Bank of India can do sale purchase of the securities in the open market operations, but not in the primary market itself. Temporary ways and means advances to tide over the cash flow problems are permitted. WMA advances are permitted. WMA advances, which are ways and means advances, temporary WMA advances, those are permitted, but also the exceptions are allowed. Exceptions are allowed, as I already told you, that the government, if declares some exceptional situation, as we have mentioned earlier, as in the case of the natural calamity, or as in the case of the national security related issues, in that particular case, if the government wants to borrow the money from the Reserve Bank of India, that may be allowed, but the government in that case has to declare that particular situation. Okay, fourth, it is related to the finance minister is required to keep parliament informed through quarterly reviews. Okay, so finance minister is to keep the parliament informed through the quarterly reviews on the implementation and further on the corrective measures if the review shows a deviation. So basically our budget is presented along with the three statements, and further there we mention the different agendas, and there must be a quarterly review, and that must be presented by the finance minister in the front of parliament itself, that what were the situations, what was the projection, are we able to achieve those projections or not, and if there is any projection, if there is any deviation, in that particular case that must also be corrected. And also the act provides that no deviation must be allowed. no deviation is permissible without the approval from the parliament, okay. So the main theme of the FRBM Act is it is related to says to reduce the dependence of the government on borrowing. So the fiscal deficit is not to be dealt from the borrowings itself. It must not be the case that the government is borrowing the amount related to the fiscal deficit and further implementing the different facilitations to the different sectors over there. It must not be the case, and it helps to reduce the fiscal deficit in the phased manner itself. So that is all related to this particular unit itself. Now now we'll be covering the next concepts. It is related to the GDP, that is a gross domestic product. So the next video we are going to cover, it is related to GDP. Let me just change the file so that we could proceed with it. We will also be covering some case studies based upon it in the end of the video. So GDP it is. So GDP means what? It means the gross domestic product. So if in a layman language, what is GDP? What is GDP? So it is a total market value. It is a total market of the final goods and services. So whatsoever the goods and services which have been produced in some particular territory, and further, let us take the case that this is a particular territory of a country A, B, C over there, and further the goods and further services have been produced. We are looking for what goods and services? We are looking for the final goods and services which have been produced, and we are looking at what value? We are looking at the market value of these. So GDP is concerned with the total market value of those goods and services which have been produced within the territory boundary of the country using the domestic resources during a given period of a time, which is usually an year. Is that clear? So whatsoever the final goods and services are there which have been produced in the territory domestically using the domestic resources, and further related to the market value of those, that is basically what that is a GDP, that is a gross domestic product. That is a gross domestic product. And when we talk about the NDP, that is a net domestic product, basically whatsoever the capital goods have been, capital assets have been utilized so as to basically render the services or so as to manufacture the goods. In that particular case, there must be some deterioration, there must be some wear and tear that is related to the depreciation that must be subtracted. So let us take the case that we use the machinery. We use the machinery related so as to render the services or so as to produce the goods. In that case, whatsoever the depreciation that has been charged, that must be reduced. So GDP minus the depreciation on the capital assets, that must be subtracted, and that is related to what? That is the NDP, that is a net domestic product. That is a net domestic product. These concepts are very, very important because these concepts are coming over there in the exam in the one-liners, or these are coming under the statement type questions, and also helpful so as to understand the case study concepts. Okay, so GDP is related to the final goods and services, the market value associated with that, and those goods and services must be produced in the country using the domestic resources within a specific period of time, that is usually a year. Okay, so that is the GDP concept. And when we talk about the NDP is basically GDP minus the depreciation, that is your NDP. And when we talk about the gross national product, it is related to whatsoever the goods and services which are produced or rendered by the nationals. Basically, if we look at the factor, if we look at the GDP itself, it is basically what? It is a territory, it's a land based concept. So whatsoever the goods and services have been produced within a particular territory. Okay, so the GDP concept is related to territory, whereas the GNP concept is related to the nationality. It is related to nationality. So it may be the case now that the Indians have been earning the amounts outside India too. Okay, so in that particular case, in the case of the GNP, that particular amount must be added up, and also whatsoever the amount has been earned by the foreigners in our country, that must be subtracted. So we are talking about what? We are talking about the net receivable. We are talking about the term net receivables over here. So what is the term it is related to? We are talking about the term net receivables, that is represented by NR. So let us take the case that in India, the persons basically earn the amount from the foreign income, which may be in the case of the property rental or the services rental outside India. In that case, let us take the case that the Indians earn basically income from outside resources amounting 30,000 crores, and further the foreigners in our India current domestically they earned amount 10,000 crores. So net receivables will be equal to what? The net receivables will be equal to 30,000 crores minus the 10,000 crores, that is equal to the 20,000 crores. That is equal to the 20,000 crores. Is that clear? So that is related to what? That is related to the net receivables, or we can say it net factor income from abroad, or it is also said to be NFIA. So both the terms are equivalent, whether it is NR, that is a net receivables, or NFIA, that is a net factor income from abroad. Both are equivalent terms over here. So we can say GNP is nationality concept, where GDP is territory concept, territory related concept. So the question is that how we can calculate the GNP. So GNP is equal to GDP plus NFIA. So net factor income from abroad, that must be added up. That would be equal to what? That would be the GNP itself. That would be the GNP itself. So GDP is geographical concept. So in that particular case, GNP is what? GNP is nationality concept. So now let us have a look at the NNP. NNP is basically what? NNP is GNP minus depreciation. That would be NNP. Simple as that. So I told you now, when we just calculated the NDP, in that particular case we did what? We basically subtracted the depreciation from the GDP. That is the depreciation which is charged on the capital assets, that is to be subtracted, and we basically calculated the NDP in that particular case. Now in this particular case we were to calculate the NNP, that is the net national product, and in that particular case we'll be subtracting the depreciation from the GNP, and that is what? That is related to the net national product. Now net domestic product, that is NDP. Now net domestic product, that is NDP. Actually this concept is I think duplicated over there with the wrong name, so I will be just deleting this particular case. Okay, next it is related to the gross national income. Next it is equal to the gross national income. So gross national income is equal to what? When we say we need to calculate the gross national income at the market prices, so it is equal to GDP at market prices. Market prices means we are calculating the GDP at the current prices. When either it can be at the constant prices, either the GDP can be calculated at the constant prices, where we are basically referring to the value of all the final goods and services from some base year. That would be GDP at the constant prices. And further, the another concept, it would be equal to GDP at the market prices or current prices. So in that particular case we are basically referring to the value of the goods and services which are produced at the current rates itself, at the market rates itself. Okay, so that is at market prices. So whenever it is said market prices, we will be referring to the market prices itself, that is the current prices itself. Is that clear? This concept particularly will be more clearer when we will be solving case studies based upon that. So GNI is equal to, that is a gross national income, is equal to GDP at the market prices minus the depreciation. Basically we are concerned about over here related to what? Related to the NDP. So whatsoever we have lost, we are not covering that. So gross national income basically is equal to GDP plus minus the depreciation plus net factor income from abroad minus the indirect taxes plus the government subsidies, that is equal to what? That is equal to the gross national income. You need to retain this particular formula, that is a GNI, that is a gross national income, is equal to GDP at the market prices minus the depreciation, whatsoever the depreciation has been charged, plus you must be adding up the NFIA, that is net factor income from abroad. It can be positive or it can be negative too. It can be positive or it can be negative too. It's not the case that it must be added up only. It depends upon is it negative or is it positive. Okay, and further minus the indirect taxes and plus the government subsidies, If I just look at this particular formula, we can look at this particular formula over here. So what it basically relates to, what does it basically relates to? If I subtract the depreciation from the GDP, it is basically what? It is a NDP. It is NDP at market prices and plus NFIA. What does it indicate? It is basically indicating the NNP na. It is basically indicating the NNP over here. I can say this is equal to what? This is equal to NNP. This is basically equal to what? It is the NNP over here. That is a net national product. And further, when we are to calculate the GNI at the market prices, in that particular case, we will be subtracting the indirect taxes. So indirect taxes and further the subsidies, government subsidies over here. So taxes, we get the subsidy from the government itself and taxes to be paid to the government. Okay, you must be understanding the difference. The taxes are to be paid to the government, and further, if we are getting subsidy, that will be credited to us. That will be credited to us. Okay, so the taxes are to be paid, and further the subsidies are received by us. So that is why the income tax, not income tax, actually indirect taxes minus the subsidy. Indirect taxes minus the subsidy and minus sign when we basically open the brackets over here. So indirect taxes will be subtracted and the government subsidies will be added up. Okay, so that is how this term is basically covered up over here. So you just need to retain this particular formula, and you can retain the GNI formula itself. So it is NNP minus the indirect taxes minus the subsidy over here. Is that clear? Is particular thing clear over here? Okay, so that would be related to it. Next, it is equal to NDP at the factor cost and NDP at the market price. NDP at the factor cost and NDP at the market price. So let us first of all understand the NDP at the factor cost. NDP is what? Net domestic product. It is what? It is a net domestic product, but at the factor cost. So the total value of the earnings received by all the factors of production. So it is basically equal to what? Total value of the earnings received by all the factors of production in the form of wages, profit, rent, interest within the domestic territory of a country during the year. So basically we can calculate the GDP by three manners. One, it is the expenditure manner. We will be covering all the three manners, and the other one, it is related to what? Income factor, and the third one, it is related to production itself. Okay, so in this particular case, we are considering what? We are considering the factor related to income only. So whatsoever the income which has been earned on the resources, whether it is related to wages have been earned, it is related to the rent has been earned, or whatsoever the income which has been earned domestically, because we are not concerned about the net national product, we are concerned about the domestic product only. So whatsoever the income has been earned domestically, that is basically what? That is the NDP. So it includes a compensation to employees. So whatsoever the amount has been paid to the employees itself, it includes the operating surplus, it includes the mixed income itself. So that is basically NDP at the factor cost. Okay, and further NDP at market prices. So market value of all the final goods and services. Produced within the domestic territory. We are concerned about what? We are concerned about the final value of the goods and services produced within the domestic territory. That we basically, the definition we read above. Okay, so that is related to what? Final value of the goods and services. Okay, so whatever the production there is and whatsoever the value it is related to it, that is basically the NDP. So NDP is equal to what? NDP is GDP minus the depreciation. So over here NDP at the market price is related to the final value of the goods and services. And further, for the stable economy, it is required that NDP at the market prices must be equal to the NDP at the factor cost. Okay, so when we say factor cost, it is related to what? It is related to we have spent the money and further we are earning out of it. So it is related to the earning aspect over there. Whereas in the case of the NDP at the market prices, we are concerned about what? We are concerned about the market prices of the final goods and services produced in the territory itself. Okay, and for stable economy, it is required that NDP at factor cost must be equal to NDP at market prices. Is that clear? So and NDP at factor cost is equal to what? It is equal to NDP at the market prices minus the indirect taxes plus the subsidies. Is that clear? This is how we will be calculating it. This is how we will be calculating the NDP at the factor cost. Okay, so NDP at the factor cost is equal to the NDP at the market prices minus whatsoever the indirect taxes over there plus the subsidies. So that is equal to the NDP at the factor cost. And for stable economy, it is required that NDP factor cost is equal to the NDP market price. Now let's consider the GDP computation. I already told you that there are three ways that we can calculate the GDP. One, it is the expenditure method. Second, it is the income method. And the third one, it is a production method or product wise. Okay, so first of all we will be considering the expenditure method. In the case of the expenditure method, we basically calculate the total expenditure of all the entities. We basically consider the expenditure of all the entities, whether it is related to consumption, whether it is related to investment, it is related to government spendings, or the net of the exports and imports. Okay, so you can simply retain it as SIG XM. You can retain it as a SIG XM. C is for consumption, I is for gross investment, G is for government spendings, X is for exports, and M is for imports. That is how you can calculate the GDP at the expenditure method. Why is the expenditure method? Okay. Then further, it is related to income approach. Income approach is related to what? So whatsoever the amount has been earned, by in the form of the wages, in the form of the property income, or whatsoever the income over there, that is basically related to what? That is related to the income approach over there. So compensation of employees, wages, salaries, and the other employee supplements. Property income may include corporate profits, proprietors' incomes, interest and rents, etc. And further, we have already covered the GDP at the market prices. Now that is all equal to what? So at market prices, we basically we are basically concerned about we focus on the market value of the goods and services, which are produced in the territory itself, after adjusting the effect of indirect taxes and subsidies on the prices. After adjusting the effect of the indirect taxes and subsidies prices. That is why in the case of the factor cost over here also, we basically fixed that particular item over here. That is as the factor cost. Is that clear? Next, it is related to the GDP at factor cost. GDP at the factor cost measures the value of output in terms of a price of factors used in its production. Measured in the value of outputs in the terms of the price of factors used in its production. So whatsoever the factors are over there, whatsoever the factors are covered over there, and what was the values, what was the amount, what was the basically different values of those production, that is basically based upon that particular purpose. Okay, so GDP at the factor cost measures the value of output in terms of the price of a factor. So whatsoever the different factors you have used in the production itself, those are basically, when considered, it is said to be GDP at the factor cost. Okay, so the factors related to production are land, labor, capital, entrepreneur. So they all get the remuneration in the form of the rent, wages, salaries. So those all are considered. That is basically related to whatsoever the amount of the incomes have been earned by them. But basically I considered outside above also the income part over there, because in the case of the GDP even at the factor cost, whether you are concerned about the amount which was spent on production, basically they are also earning out of it. But when we are considering it related to the income, related to the cost factor itself, the main purpose over here, it is related to what? It is basically related to income itself only, that whatsoever the amount we have been earning related to those expenses made on the cost made on the production itself. Okay. So GDP at the factor cost is equal to what? It is equal to GDP at market prices minus the indirect taxes plus the subsidies. I already told you that this term was to be subtracted, but this term is not in the brackets. So that is why the plus sign is here. Otherwise the subsidies are to be subtracted from the indirect taxes. Okay. Further, it is related to the product approach. The third one, it is related to product approach. So GDP is calculated as an aggregate of sector-wise production. So we can see a country may have different sectors over there, and further we do calculate it for the different sectors, and further we aggregate them, that is totaling them, is basically giving us the GDP overall. It gives us a GDP overall. So in India we are having the 8 sectors. We calculate how much has been produced in each sector. We do calculate what? We do calculate that how much has been produced in each sector, and aggregate of that particularly gives us what? It gives us the GDP figure. Okay, so first of all, we do calculate the GDP. We do calculate the GDP, or we can say the best produced, the goods so produced, services so rendered in some particular sector for all the sectors individually. Then we add them up all. So that is a product approach. So real GDP or GDP at constant price. So real GDP or GDP at constant price, it is basically related to what? It is related to today's output at the base year price. Today's output at the base year price. I already told you, when we are considering it related to the real GDP or GDP at the constant prices, we basically consider the value of the goods and services so produced as per the base year prices, and further, in the case of the nominal GDP, we basically look at the current year prices. In the case of the nominal GDP or at the GDP at the current prices, we basically represent the goods and services value, final value in terms of the current prices. Okay, so real GDP, it is calculated after removing the influence of inflation. We do not consider the inflation factor in the case of the real GDP, and it reflects the real growth. Let us take the case that if we take the base year as 2012 and further the GDP in that particular case, let us take it, it was 5.3, and we are calculating the GDP, real GDP, and in 2021, and that comes out to be 6.3 in terms of the base year values. Then it basically reflects the real growth now. But if we are considering the GDP at the nominal cost, in that particular case we are considering the GDP at the market prices, itself. Now you already know that there is also inflation factor. Definitely your production is going to be increased. Definitely your production amount is going to be increased, but you must be looking at the factor that how much it has increased from the base year itself. So we must be considered more about the real GDP if we want to look at the real picture of the growth. Okay, so nominal GDP or GDP at the current prices represents the total money value of the final goods and services produced in the given year, where the values are expressed in terms of market prices. So in case of the nominal GDP, we are concerned about the market prices itself, that is the current prices itself. Is that clear? So let us have a look at the limitations of the GDP. What are those? So GDP does not speak about that how GDP is distributed among the population. So when we say that GDP, a country is having higher GDP, we do not have a look about it how the amount is distributed or how the production is distributed along the country itself. And further, per capita income, which is another derivative of the GDP, also does not indicate the pattern of income distribution. So whether the per capita income is equal to 500 USDs or it is equal to 50,000 USDs, it basically makes no sense, because it does not account for the pattern of income distribution. It may be the case that income is highly distributed for a few people, and for many of the people or higher percentage of the population may be having below poverty line income. Okay, so that may also be the case. So GDP is having the limitation related to that. Further, there could be regional disparity in GDP. GDP, where we are concerned about the GDP of the nation. It may be the case that some of the states are having very low GDP, where some of the states may have very high GDP. Okay, higher GDP does not necessarily imply higher welfare. So welfare is a wider concept. It is basically related to what? It basically comprising of health, education, sanitation, etc. And we cannot interpret that high GDP will basically lead to high welfare over there. It is not related to that. And further, that is to be supplemented. That must be supplemented by the HDI, that is a Human Development Index. Is that clear? And the fifth one, it is related to GDP does not reflect the total income of the country. It does not reflect the total income of the country. If the country is export-oriented economy, GNP is more accurate. Because in case of GNP, we are considering what? We are considering the net receivables also. Okay. So these are the limitations related to the GDP. Okay, sixth one, it says GDP does not throw light on how much of the population is financially excluded or included. So GDP does not throw light upon that, and also the concept of green GDP must be emphasized, must be focused upon, because when we are trying to develop ourselves, it may also be the case that we are following those practices or those policies or those production instruments in which the quality of the environment is degraded, by which the quality of the environment is degraded, and for the cost of that is also to be included. Cost of debt is also to be included. So country may be achieving very high GDP, but at the cost of the environment degradation. So these environment issues must be looked into and must be factored in GDP itself. Okay. Next, it is related to some important and the newer concepts related to GDP. Let us have a look at it. So CSO, that is a Central Statistical Organization, in 2015. CSO introduced what? CSO introduced changes in the computation of the GDP. It introduced the changes in the computation of the GDP. So as per the changed criteria, the headline growth is to be measured as per the GDP by constant market prices. It must be measured in terms of GDP at the factor cost, and further it is to be measured at the constant market prices. Okay, so that was the first change. And also sector-wise estimates of GVA shall be at basic prices. These must be at the basic prices. So GVA, that is a gross value added, must be at the basic prices, and the GDP must be measured, the growth, headline growth must be measured by the GDP at the constant market prices. GDP at the constant market prices. Is that clear? Okay, now let's have a look at the GVA, that is a gross value added. So the GVA is an economic measurement used to calculate the productivity in the economy. It is used to calculate the productivity in the economy. So it is difference between the total economic output and the intermediate consumption goods. So whatsoever the intermediate goods have been consumed and what was the economic output, it is basically related to what? It is a gross value that is added up. It is related to the gross value that is added up. So whatsoever the amount that has been consumed and further whatsoever amount is the total economic output. So difference between these two is what? It is the GVA itself. So the relationship between the GVA at the factor cost and the GVA at the basic prices and GDP is related over there. Let us have a look at it. GVA at the factor cost and further the GDP, let us have a look at. So first of all, it is GVA at the basic prices. You just need to have an idea related to this. We will be covering the case study related to GDP after this session itself. Okay, so GVA at basic prices equal to CE plus OS and further divided by MI plus CFC, that is plus the production taxes less the production subsidies. So what is it is related to? CE is related to what? CE is the compensation of employees, OS is the operating surplus, MI is the mixed income, CFC is the consumption of a fixed capital. That's just an idea that you have to have about the GVA itself. So GVA is what? GVA is the gross value added. GVA is the gross value added, and GVA at the basic prices equal to CE plus OS divided by MI plus the CFC and further the production taxes must be added up, and further the after subtracting the subsidies from it, okay. And GVA at the factor cost is equal to GVA at basic prices minus the production tax less production subsidies, minus the production tax minus the production subsidies. So GDP is basically equal to what? GDP is equal to summation of the GVA at basic prices minus the production tax plus the product subsidies, and this formula is to be retained. This formula, the third one, it is to be retained. The GDP is equal to summation of the GVA at basic prices. So whatsoever the GVA, that is gross value added at the base prices over there, and we must be subtracting the product tax, and further will be adding up the product subsidies if you will be receiving any. Is that clear? So that is how we can calculate the GDP in the different scenarios. Now further we will be solving a case study based upon it. So it says we are basically provided with the different data over here: consumption, government spending, imports, subsidies, and all the data is given over there. And we need to calculate the GDP at the cost factor first of all. We need to calculate the GDP at the cost factor first of all. So kindly please do calculate it and answer at the earliest. So whenever I say we need to calculate the GDP at the cost factor, it must be kept in mind that first of all we will be calculating the GDP as per the expenditure method or GDP at the market prices, and after that we will be basically dealing with the indirect taxes and the subsidies. We'll be dealing with the indirect taxes and subsidies. That is related to what? That is related to GDP at the cost factor. If you remember, when we basically learned the concepts related to the NDP at the cost factor, we also learned the same thing, where I told you that NDP at factor cost is equal to NDP at the market prices, and further minus the indirect taxes plus minus the subsidies. So that was a formula related to it, and that we need to cover, and that we need to calculate in this question itself. So kindly please do answer at the earliest. So kindly do answer at the earliest related to this particular case study over here. So we have already been provided with the data. So let me solve the question for you. So first of all, we will be calculating the GDP. First of all, we will be calculating the GDP at the market prices, that is equal to what? As per the expenditure method, I already told you what is the formula related to it. It is a SIG XM. It is a CIG XM, that is a X minus M. This is the formula related to it. This is the formula related to it, and we need to calculate the GDP at the market prices first of all. So C, that is a consumption, which is given to be 60,000. All figures are here in crores. I is equal to what? I is equal to the gross investments. I is equal to what? I is equal to the gross investments. The concept is not difficult at all. We will be considering all the important facts related to it. So kindly please do not miss it. Just concentrate on the current question itself first of all. It is related to, I'm asking related to GDP. So GDP is related to what? I already told you. So whatsoever the goods and services have been produced in the country, related to the final value of those goods and services which have been produced domestically into the countries, that it is related with. So GDP is concerned about what? GDP is concerned about whatsoever the amount of the final value of the goods and services which have been basically produced over here in the territory itself. Okay, so that is how we are solving. So I'm just telling you that there are three methods that we can calculate the GDP. That is GDP by the expenditure method, by the income method, or by the production method. In case of the expenditure method, we are basically concerned about the SIG XM, because otherwise we will not be able to solve the mathematical. We have not been provided with the data over here. So we will be basically doing what? We will be covering as it is SIG XM by applying the expenditure method SIG XM. So C is equal to consumption is equal to 60,000 crores. I, that is a gross investment, it is a 50,000 crores, and G is equal to, that is government spendings, it is given 15,000 crores, and for the X minus M, X is basically related to the exports, that is 1,10,000 crores, minus the imports, that is a 70,000 crores. That is what we need to calculate right now. So it is equal to what? It is equal to the 1,10,000, and further 1,10,000, this would be 40,000. So that is 150. That is 1,50,000 and plus 15,000. And plus 15,000, what it would be equal to? It would be equal to 1,65,000 crores. So GDP, we can say GDP at the market prices, or GDP simply we can say that it comes out to be what? It comes out to be, I'm writing it over here. So GDP comes out to be 1.65 lakh crores. So it is 1.65 lakh crores. Is that clear? That is what we calculated right now. That is the GDP at the market prices. After that, we need to subtract. So we need to calculate the GDP at the factor cost now. So GDP at the factor cost is equal to GDP at the market prices, and we need to subtract the indirect taxes, and further the subsidies from it. That is the formula related to it. So GDP at market prices we already calculated, that is 1,65,000 crores, and further minusing the indirect taxes are given to be what? These are given over here. Indirect taxes are mentioned to be 12,000 crores. Minus the subsidies, which are mentioned to be 8,000 crores. So this is how it will be done. And further 1,65,000 crores minus 4,000 crores, that is 1,61,000 crores. that is 1,61,000 crores. That is how we can do calculate the GDP at the cost factor. That is GDP at the cost factor, that what was the cost that was related to it, that what was the cost that is related to it, that we subtracted the taxes and further the subsidies that we had, that the subsidy that we had. Okay, so that is how we can do calculate the GDP at the factor cost. Next question that we are going to cover, it is related to, let us have a look at it, that what the second question says over here. So we need to calculate the NFIA or national, or we need to calculate the net receivables. So we need to calculate the NFIA, net factor income from abroad, or net receivables. Second question, it is related with that we need to calculate the NFIA or net receivables. Kindly please do answer at the earliest. I already told you that what NFIA is related with. NFIA is related with the term that what income has been earned by the nationals outside territory and what other foreigners have basically earned the income from India, from our territory domestically, So this income that is basically is to be added up and that is to be subtracted, and the net effect would be the NFIA, that is the net factor income from abroad. That would be the net factor income from abroad. If we just look at the factor over here, so it says total capital gains from income overseas. Total capital gains from income overseas, it is what? It is given to be 20,000 crores. It is given to be 20,000 crores minus income earned by foreign nationals domestically. Income earned by foreign nationals domestically, it is given to be 3,000 crores. So it will be equal to 17,000 crores. It will be equal to 17,000 crores. So Priyanka has answered correctly at the earliest, that is 17,000 crores. So the answer would be, answer of the NFIA or net receivables, it will be equal to 17,000 crores in this particular case. Is that clear? Okay. Next question that we are going to calculate, it is related to the GNP. We need to calculate the gross national product. We need to calculate the gross national product. What is GNP actually? It is gross national product. We are considered about the nationality concept in the case of the GNP, not related to GDP. So GNP is equal to what actually? GNP is equal to GDP plus the NFIA factor. And if you remember, we calculated GDP, and whensoever it is not mentioned, the question is silent about the current factor cost or about the market prices, we'll be calculating what? We'll be calculating at the market prices itself. So what was the GDP that we calculated earlier? It was 1,65,000. It was 1,65,000. And further, the NFIA is what? NFIA is 17,000 that we calculated. So it will be equal to 1,82,000. So it will be equal to 1,82,000. Is that clear? Is this particular part clear over here? So this is how we can calculate the GDP and further the GNP, and that was related to this particular case study. And that was particularly related to this case study. Now let's move to the another case study, which says, I think it's quite not visible over here. Let me narrate this for you. So market value of a final goods of services. So this must not be visible over here. Let me just narrate the values to you. Let me just narrate the case study to you. So it is mentioned over here, market value of a final goods and services produced within the domestic territory in India in year 2018 and 19. So the market value, so it is basically related to market value of our year 2018 and 19. It is mentioned to be 11355. It is mentioned to be 11355, and further related to as per the base year prices, of 2008 and 9, as per the base year prices 2008 and 9, it is mentioned to be the market value is given to be 5742. It is mentioned to be 5742. I'm writing the figures over here. So as per the year 2018 and 19, the market value is given to be 11355, and as per the base year values, it is given to be what? It is given to be 5742. So we can basically understand that this value is basically what? This value is a real GDP. This value is basically given to be what? It is given to be real GDP. Okay, and further this particular value, it is relating to what? It is related to the nominal GDP. It is related to nominal GDP. isn't it? Isn't it? Real GDP is basically related to what? Real GDP is based upon what? It is related to base prices, na? It is related to base prices. I basically, not inadvertently, intentionally, just I did that so as to make you understand related to it. So let me just tell you related to that 11355. It is related to what? It is related to real GDP or nominal GDP. It is related to nominal GDP or real GDP. Kindly please do confirm at the earliest. Kindly please do confirm at the earliest. Real GDP is basically concerned with constant prices. Real GDP is basically concerned with constant prices. Let me tell you, this was basically related that real GDP is related to the constant prices, that is related to the base year prices. So here it is a real GDP, and further over here it was what? It was a nominal GDP. Okay, so do not just listen to it, be basically clear about the concepts. Let me tell you again. When I talk about the constant prices, it is related to what? It is related to real GDP, which reflects the actual growth, if you remember, which reflects the actual growth. But in the case of the nominal GDP, it is related to the current prices or the market prices, or it related to market prices. Okay, so it is the nominal GDP over here and real GDP over here. And further, we are provided with the different amounts related to amount on government taxes, amount on subsidies allowed by the government, import, exports, net receivables, consumption, gross investments, and the government spendings over here. First of all, first question it says GDP for year 2018-19 at constant prices is. GDP for year 2018 and 19 at constant prices is. What would be the answer related to it? What would be the answer related to it? So kindly please do answer at the earliest. We need to calculate the GDP, and that is for year 2018 and 19, and further it is to be calculated at constant prices. So what would be the answer related to it? So the real GDP would be the answer. The real GDP would be the answer, na? That is at constant prices, means we need to calculate the real GDP, and I have already told you the concept that the real GDP is 5742. So the answer is 5742 over here. Clearly the answer is 5742. So you must not be confused related to it. So real GDP would be the answer over here. That is 5742. That is the GDP at the constant prices. Is that clear? So the first question was just a conceptual one. If you just know the concepts related to it, what is real GDP, what is not, in that case you must be able to answer those. You must have been able to answer those. So now let's move to the another question that it says GNI, that is gross national income at market prices. At market prices for year 2018 and 19 are to be calculated. Now over here we are concerned about what? We are concerned about the GNI. We are concerned about the GNI at the market prices. We are concerned about GNI at the market prices. So what would be the formula related to it? So what would be the formula related to it? So kindly please just confirm at the earliest, just tell it the earliest. What is the formula related to the GNI, that is a gross national income. That is a gross national income. Real GDP is current year. No, real GDP is not related to current year. Real GDP is basically based on the prices of the goods and services based upon the base year. So over here the base year is given to be 2008 and 9, and based upon the prices of that particular base year we calculate the GDP for the current year. Are you getting my point? So that is basically related to what? The GDP at constant prices, or we can say the real GDP itself. Okay, we are calculating the GDP for the current year itself, but not at the current prices. We are calculating the GDP for the current year, but at the base year prices. Okay, so that is a concept related to the GDP at real GDP. And when we talk about the nominal GDP, we are calculating the GDP for the current year and also at the current price, and also at the current prices. So here Rahul Singh Rajput has answered the formula related to GNI. He has mentioned it as GNI at market prices is equal to GDP and minus the depreciation if there is any, plus the net factor income from abroad, and further we need to separate the indirect taxes and plus the government for the subsidies. Those are to be added up. So this is the formula related to GNI. This is the formula related to GNI over here, isn't it? So in case of GNI, we are concerned about this, and particularly in this particular method, this is based upon what? This is based upon the, this is only and only based upon what? This is only and only based upon the goods and services produced in the domestic territory. It is clearly mentioned in the question itself. In this particular case, the GDP that we are just referring to. Let me write it over here. GDP at the GDP, that is a real GDP. I'm writing over here real GDP, that is GDP at the constant prices. It is 5742. And further, the GDP at the nominal prices, or we can say the nominal GDP over here, the value is given to be 11355. The value is 11355. So it is clearly mentioned in this particular case. This is clearly mentioned in this particular case in the line over here, that market value of the final goods and services, produced within the domestic territory. Okay, so when we are saying basically produced within the domestic territory, it is not considering what? It is not considering the nationality product. It is not considering the nationality, and we are concerned about what? We are considered only and only related to domestic, or related to our territory itself. We are basically concerned over our territory itself. But over here, the concept, it is related to what? It is related to GNI, that is a gross national income. We must be considering related to exports and imports. So this particular GDP over here that we are considering is not considering what? It is not considering the exports and imports over here. So that must also be added up. So that factor must also be added up. So we will be writing exports minus the imports. Exports minus the imports, that is also to be mentioned herein. Okay, otherwise your formula is same. Otherwise the formula is same, but related to question we need to look into this. Related to question we must look into it. Okay, so GDP, what GDP will be considering over here? Kindly please do answer at the earliest. What GDP amount we will be considering? Because it is at market prices. We need to calculate the GNI, that is the gross national income at the market prices. So what GDP would be considered? Nominal GDP would be considered. So the nominal GDP is 11355. So it is 11355. And is there any depreciation given over here? I don't think so. There is any depreciation amount provided over there, so that is not to be considered. The another factor, that is net receivables. So net receivables are given to be what? Net receivables are given to be 60. These are given to be 60, that will be added up. And the indirect taxes, if there any, is there any indirect taxes which are given over there? Are there indirect taxes? Yes, the amount of indirect taxes is given to be 226. It is given to be 226. It is not clear over in the picture over here. Let me tell you, it is 226. And further, the subsidies are given to be what? Subsidies, amount of subsidies allowed by government, it is given to be 54. We will be adding up the 54. And further, exports are given to be of what amount? Exports are given to be of 280. Exports are given to be 280, and minus the imports are given to be 340, and that is to be subtracted. That is how we will be solving the GNI at the market prices. That is how we will be solving the GNI at the market prices. Is that clear? Is this particular part clear over here? Okay, let me solve this for you. So it is 11355 plus 60 minus 226 plus 54 plus 280 minus 340. That is 11183. 11183 would be the right answer in this particular question. So GNI at GNI, that is a gross national income at market prices, you must look into the factor that we are considering the market prices over here. So the GDP would be related to market prices itself. That is a GDP at the market prices, that is a nominal GDP we are concerned about, and that is to be taken over here. And also this particular GDP is related to domestic produce only and is not covering the exports and imports, so that must also be considered. So whatsoever the amount that you have exported minus the imports, that must also be considered. And further the other aspects are all the same. Okay, so that is how we can calculate the GNI at the market prices. Next question that we are going to cover over here, it is related to that gross national product for the year. We need to calculate the gross national product for the year 2018 and 19. We need to calculate the gross national product. We need to calculate the GNP. Kindly please do let me know the formula at the earliest. What is the formula related to gross national product? What is the formula related to the gross national product? And I already told you, whenever the question is silent about the market prices or the constant prices, you will be considering the market prices only. You must be considering the market prices only. So question number 3, we need to calculate the gross national product for the year 2018 and 19. We need to calculate the gross national product over here, and that is equal to what? That is equal to GDP plus NFIA. That is equal to GDP plus net factor income from abroad, or we can say net receivables in this particular case, or we can say net receivables in this particular case. And when we are considering the GDP concept over here particularly, I already told you that over here the GDP which is given over here, we are not concerned about what, basically we are not considering the import or exports in this particular case now. We are not considering the imports and exports in this particular case. So what would be the right method or right answer related to it? What would be the right answer related to it? Kindly please do answer at the earliest. What would be the answer related to question number 3? We need to calculate the question number 3 over here. That is a gross national product for the year 2018 and 19. So it is GDP plus NFIA. It is GDP plus NFIA as such. So GDP is basically 11355. It is a 11355 plus NFIA. It is given to be 60. It is given to be 60 over here. So what would be the formula related to it? What would be the, not a formula, what would be the answer related to it? So if simply it is asked to you that you need to calculate the GNP, so what is the answer related to it? It is 11355 plus 60. But in this particular case, the GDP that we calculated over here is not considering the export or import factor over here. That is, it is not considering now. So what would be the answer related to it? So kindly please do let me know at the earliest. The right answer over here is GDP plus net factor income from abroad. So GDP that we are considering 11355 plus 60, that is basically 11455, but also the export import factor, is to be considered. So it is export minus the imports. So the exports are given to be 280 minus 340. So 280 minus 280 minus 340 plus 11415, that is equal to 11355. So the answer over here would be equal to what? Net factor income from abroad we are adding up over here. So what would be the answer related to it? So what would be the answer related to it? It will be 11355 plus 60 minus export import factor over here. So it will be exports minus the imports, and it will be equal to what? It will be equal to export import is given to be 60 over here now, minus 60. So it will be 11355 only. So the answer will be 11355 only. That particular factor is to be export minus imports, it is na. So it is to be subtracted as such. So it will be 11355 itself. Is that clear? Next we are going to calculate the next question. It says, let me tell you the question itself. So it is that you need to calculate the GDP by the expenditure method. So as per the question number 4, you need to calculate the you need to calculate the GDP as per expenditure method. So as per the expenditure method, we need to calculate the GDP. Kindly please do answer at the earliest. What would be the amount related to it? So GDP as per expenditure method we need to calculate. So what is the formula related to it? It is a sig xm. So C plus I plus G plus X minus M. So that is the formula related to it. C, that is related to consumption. Consumption over here it is given to be 7,500. And the investment, that is gross investments, is given to be 2,000. And the government spending is also equal to 2,000. Plus the export minus imports. Exports are given to be what? Exports are given to be 280 minus the 340. And what would be the answer related to it? So kindly please let me know the question number 4. What would be the answer? So it is 7,500 plus 4,000 minus 60. So it is equal to 11440. So the right answer over here has been posted by Manju Asrani at the earliest. That is 11440 is the right answer. Question number 4 over here. Is that clear? So on a nutshell, we can say, if we are talking about the GDP itself, there are 3 methods related to that we can calculate it. One, it is a expenditure method, and income method, and further the production cost method, and further the production method. Okay, that is how we can calculate the GDP itself. GDP is all about the final value, or we can say the market value of the final goods and services so produced. If we are talking about the definition of GDP, it is related to the market value of the final goods and services so produced in the territory itself within a particular period of time, which is usually a year. Okay, and when we are saying the GDP at the constant prices, we are focused on real GDP, and we are talking about the GDP at the market prices. It is related to nominal GDP. Is that clear? Now do let me know the formula of the GDP deflator. So kindly please do let me know the formula of the GDP deflator. We just discussed in the previous lecture itself. So what is the formula of the GDP deflator? What is the formula of the GDP deflator? When we were talking about the inflation, when we covered the formula related to the GDP deflator, so kindly please do let me know at the earliest. Kindly jaldi se jaldi yahan par post kar dijiye, and that would be all related to this particular video. I'll be taking it as an exercise from you guys, so you need to post a comment as early as possible related to the GDP deflator. What would be the formula related to it? So GDP deflator is basically what? It is a nominal GDP to the real GDP multiplied by 100. Nominal GDP. Shiv Vishnu has answered correctly at the earliest. So it was a GDP deflator. The question can be asked in the exam itself. So do not take like that the question was not basically given over there. So it is given GDP deflator we are talking about. So GDP deflator is equal to the nominal GDP and further divided by the real GDP multiplied by 100. So that is a GDP deflator. Okay, so that would be all related to this particular video.